Well, what's going on? Emerge the Real Estate Podcast audience. This is your host, Aline Bakari, and I'm telling you, I know I say this every week, but man, I'm serious. This week, I am just blown away. I'm just really blown away by the guests that I have, the information that's going to be gleaned, the help that is going to be there for you. And so I just want to tell you, I have a special guest today. But before we get to that, let me also say this, that this Emerge the Real Estate Podcast is sponsored by Victory Capital. And Victory Capital exists for one reason and one reason only, and that is to connect investors to capital. And so if you are a new investor and you're trying to come out of the shadows and finally close a deal, I can help. Victory Capital can help. And if you're a seasoned investor trying to scale your portfolio, we can assist you with that as well. So check us out. It's VIKTORY, victorycapital.com. All right. So now, without any further ado, I am going to introduce to you real estate attorney, business attorney, deal strategist. I mean, just a real estate and business legal professional. And so, Sean Tate, how are you?
I'm doing so well, doing very well, and thank you for having me this morning. Appreciate it.
Good deal, good deal. So, it's so interesting of how connected we are when we don't even know how connected we are. And I didn't know that I had two connections to Sean, and it was like, man, it's just crazy. So everything just fell in place. And so I'm excited to have you. And so, Sean, I want to first of all start out by saying this. The Emerge Real Estate Podcast was birthed out of the idea that me being a real estate investor and having gone through a tumultuous time back in 2008, there were some hard lessons that I paid a huge price to learn. And so what I want to do with this podcast and just my overall purpose is I really want to help business owners and investors not make some of the same mistakes that I've made. And so one of the biggest mistakes that I made was, man, I was doing millions of dollars in real estate transactions and I didn't have a team. I didn't have an attorney. I didn't have a CPA. I didn't even have a bookkeeper, Sean. I'm doing just all this, man, on my own. And so I took a big beating, man. I mean, I still have the scars on my back now. And so one of the things that I want to do is I want to help people not make that same mistake. So I'm introducing the Emerge audience to professionals that can help you grow and scale and also provide the safety that you need. And so That's why I was so excited about having you on. So if you can, Sean, tell us about you and TLC Consultants.
Sure, absolutely. I'm originally from the Chicago area, Chicago, Illinois. Grew up in the far south suburbs of Chicago. Went to high school up there, up through high school, and then moved to Texas. Most of my family's from Texas. A lot of folks from the Palestine area in West Texas. So we moved to Katy outside of Houston and, lived there for a couple of years before going to college at University of Texas. And I spent a lot of time in Austin at that point, went to undergrad there. I worked for a nonprofit prior to becoming an attorney. I was always interested in helping people, you know what I mean? Always interested in trying to make other people's lives a little bit easier, help them navigate their path. So, I worked for a statewide organization that did some lobbying on behalf of domestic violence shelters. And then I, from there, worked with the athletes at the University of Texas, technically a nonprofit, I guess, university and everything. Worked with them on, just building out life skills, consulting with them on, what to expect after college, for the folks that are going pro and not. So that kind of work really got me into, consulting with people about what happens next. What are you going to do with your life, with your business? And so it was really, really interesting work. And I realized I could have an even bigger impact and share more and educate better, with some experience in the legal field in that corporate and real estate space. So that was my goal. I said, hey, if I'm going to go to law school, I'm going to study real estate and corporate, and that's it, or else I'm not going to go. And then I'm going to go practice, or else I'm not going to practice, because those are the things I care about in terms of creating, economic engines for people to be able to do what they want to do, with their lives. I mean, I do believe in the importance of nonprofits, but having worked in that world, at the end of the day, the dollar kind of is what really makes a difference, man. You know what I mean? And,
Yes, it does. Yep.
Even nonprofits, they're run on private dollars, for the most part, right?
Mm-hmm.
So that just kind of became my goal, is to help people to move their businesses forward, move their dreams forward, in ways that could create wealth for themselves and for their families and for their future generations. After law school, moved to Dallas. Worked at two large DFW based firms, focused on commercial real estate and corporate law. So where, most of the major development companies in the country, working on deals, ranging, I guess, in size from setting up small retail centers to the last tower they built at Uptown on Clyde-Warren Park. We did the legal work for that, so just real big range of types of projects. And then, about 2 years ago, a little over 2 years ago now, I had developed a good base of clients and folks that trusted me and wanted to work with me. And I decided to take the leap and open my own practice so that I could better serve the folks that I wanted to serve in the first place, which are small business owners, entrepreneurs, mid-sized business owners, people that are, again, making their dreams realities and kind of need that help and protection and strategy along the way to make sure they do it in a way that protects them.
Great. So you decided to specialize in the business, in the corporate and the real estate arena. So if you can tell me some of the things that you see as far as like the importance of having a good operating agreements. I mean, joint ventures. I mean, entity structure. So if you can kind of speak to that.
Sure. Okay, so first, at the most basic level, and most folks, understand this. At the most basic level, it's about two things, really. It's about liability protection and taxes.
Okay.
So, when you run a business in your own name, as a sole proprietorship, as it's referred to, or a DBA, you take on all the risk of that business. And if you are, going to flip one house, okay, that's cool. At the end of the day, that liability was probably going to run back to you anyway. But if you're going to run a real estate business in that same space of flipping houses, you might have 20 homes, you might have 30, you might have 50 if you're really doing well. With every new home you have, the opportunity for something to happen on one of those properties, for somebody to slip and fall and get hurt, or for a roofing issue to cause some significant property damage to the people that are in those homes, increases with every new acquisition. And so if you're acquiring properties and running ultimately these little businesses, each of these real estate interests under one roof, under your roof, well, then if one thing happens on one of those properties, you got these, say, 30 properties out there, and you go out and mow the lawn and have the lawn service come out, and somebody leaves some grass clippings in a place, and an old lady slips on them. And her $400,000 medical bill lands at your door. Well, if you don't have all those properties in different entities, then all of it's up for grabs, right? All of it's up for grabs at that point. So the number one thing is liability. You want to set up everything you do, every entity you have, every real estate property you have in its own entity, so that you are sheltered from any potential catastrophes that could happen on one of those properties, which is just, not unlikely. The bigger your business gets, the more successful it is, the more likely it is something's going to happen. It's not a bad thing, on your part. It just means you're running a big business. So again, the number one protection is liability. by putting all of those different entities or all those different properties into their own corporate structures. Now, when somebody wants to sue you, they can only sue that corporate structure. So they can only get the value of that one property, not your entire portfolio.
Okay. Okay. So if I have 15 houses, what you're saying, if I'm hearing you correctly, I need to have all 15 of those houses in separate, what, LLCs, S corps, or?
Yeah, generally an LLC is fine.
Okay.
I mean, they're kind of invented to be the most malleable and easy to adjust type of entity.
Okay.
So LLCs work fine. There's a reason everybody uses them.
Okay.
They really are kind of the most user friendly
Okay.
entities. And the answer to your question is yes, absolutely, yes.
Okay.
I mean,
Okay.
it's a relatively small investment. When you think about it, to set up an LLC.
Right.
Now, we're not talking about running a whole company for each one of these. We're just simply talking about setting up an LLC. I'm pretty sure most, if not all of your listeners have hopped on LegalZoom or hopped on Rocket Lawyer and set up an entity. You know what I mean? It's essentially an insurance policy, if you will, that, I'm going to pay this extra, $500 or whatever to make sure that if something happens on any of these properties, any of these 15 that I own, that each of them are protected from the other one, right?
Gotcha.
So it's good business. It's not a large expense, and I highly recommend that everybody does it. And I can tell you all the serious developers absolutely do it. Every single one.
Okay. Okay. All right. So let me ask you this. So let's talk about JVs and syndications and all of that. So how should those be structured? And what would be a scenario where you would use a JV as opposed to forming a syndication?
Yeah, that's a great question. I like the way you asked it too, because it just depends on the deal, right?
Okay.
Which one, what type of legal structure you use, totally depends on exactly what deal you have, right? And it's like, you go to a car dealership and something's, making a clicking noise. Well, the solution is based on where the problem is, right? So it's the same kind of thing in deals. So a situation where you might want to do a JV type deal, probably the most common ones I've seen in the real estate space are going to be, you're a landowner, right? Or you're a developer. You're one of those two. And you, if you're let's assume you're the landowner. You say you don't know how to develop land, right? Which, I mean, it's a career, not a lot of people can just like hop up and, develop a bunch of raw land. There's zoning and entitlements. There's getting all of your utilities out to that land. And that's before you even get to the part of actually building anything on the land, right? So it's a big deal. It's a big project. So if you're one of those landowners, you got a piece of land that you think is valuable. It's in a place where something could be built, could be residential, could be commercial. Well, maybe you don't want to just sell it off. Maybe you want to participate in the long term with a deal like that. So what you would do is you find a developer or a development company and join into a JV or a joint venture. A joint venture is not a corporate entity. It's a concept. And basically the concept is, I'm going to bring something to the table, you're going to bring something to the table, and we're going to work together. But generally, when people talk about a joint venture, that's what they mean. Somebody brings, in the real estate space, somebody brings land, somebody brings development expertise, and they form a company that owns the property, right? So this company is going to own the property, and each of those parties, the landowner and the developer, is going to own a chunk of that company. They're going to own part of the company that owns the land.
Gotcha.
So in that way, you don't have to sell your land off. Say, somebody offers you $1 million for the land. Well, that's great. But what if they're about to build a shopping center on that land, right? So you can have your $1 million today, or maybe you have 20% of a project that's going to be around for the next, 60 years, right? And if you're in that kind of project, yeah, you may not get that huge chunk of money, but your 20% may be worth that $1 million just right there, just to own it. Let alone now you're participating in the rents that property is generating, right?
Gotcha.
Now you're an owner and can build more business and get more credit and do more things based on your ownership of that property. So, at any rate, a JV, generally a joint venture, looks like somebody's bringing land contribution to the table and somebody's bringing development contribution to the table. And then, our firm, other firms, plenty of firms, will help sort of craft that the paperwork that goes into that.
Gotcha. And then as far as the syndication, so you said it just depends on the size of the deal. So that's typically a larger transaction, right?
Well, yeah, it can be, but it's not really about the size of the transaction from a from a financial perspective, it's more about who's involved, right?
Okay.
So a JV is like a couple of people, a couple of parties.
Okay.
You're not going to have a JV with like 5 to 10 to 20 different people in it, right?
Okay.
And the reason is because a JV is really like a couple of folks who are kind of on an even level together, who are going in to do a project together, right? It's
Gotcha.
a joint venture. A syndication is, I am going to do all the work. I'm going to go get the land. I'm going to go build it out. I'm going to do the rehab. I'm going to rent it out. I'm going to do all of this stuff, right? I'm doing everything. I just need your money. Totally
Okay.
different thing, right? So it's about the relationship of the parties. In a joint venture, we're holding hands and walking this road together, right?
Okay.
In a syndication, which is also referred to as, private placement or a private equity offering, or there's a million names for it. I'm sure you guys have seen out there. Regulation D, filing, 506B, 506C. We can get into all that, but generally speaking, the overall idea is, I'm a developer. I know exactly what I'm doing. I even have the property identified some of the time. I'd say most of the time. I just need money. And my friends don't have it. So I've got to go raise money from people who aren't like my friends and family, which is, let's be honest, the vast majority of people who are going to do deals, right? Can't go out and say, hey, we're not Donald Trump, okay, Dad, can I borrow $1 million? It doesn't really work like that, right? You have to go out to your network and go out to your network's network, to try to raise funds. And in order to do that, you have to have a syndication in place or a private placement in place. And the reason for that is that the government has a vested interest in making sure that developers don't divest people of all their savings, essentially what it comes down to. They want to make sure that if you put a deal together and you bring people into your deal, that it's a solid deal and that the people who are going into it truly understand what's going on with the deal. Right? They have to know all the risks that are associated with the deal. You have to disclose all the aspects of it. You have to deliver a sound business plan to them and give them an opportunity to decide if they want to invest.
Right.
So that's essentially the major difference between a JV and a syndication.
All right. And then with the syndication, also you get into accredited investors and non-accredited investors. Is that correct?
That's correct. So, to kind of to continue drilling down on that concept of, protecting people's, hard-earned savings, that's really what accredited versus unaccredited is about. So an accredited investor, the easy version of it is they already have a lot of money. There's a bunch of rules around it, $100,000 this year, or if you're married and each of you made $400,000, yada, yada, or if you have $1 million in net worth, those are technically the rules for individuals, right? But there's different rules for if you're a trust or if you're investing from an IRA or if you're investing from another entity. But what they all come down to is, are you rich already, right? So if you're rich already, then the law kind of assumes that you can absorb this investment without, completely being ruined, right?
Yeah, right.
So that's what makes you an accredited investor. So the law has less interest in protecting you at that point, right? Because they're like, you can protect yourself. You're already rich, like you'll be fine. So the way that plays out, of course, on the other side is the law does want to protect people that aren't in that position, right? So if you're somebody who, has a good salary, good job, or you've saved a lot, or you've got a nice IRA, but that's pretty much your nest egg, right? The government's not going to allow a developer to come out and take that money from too many people at once, right? So what that means is the law states that I, as a developer, can only have up to 35 people in my investment that are not accredited investors.
Okay.
35 people that are unaccredited investors. And that's, again, the vast 98% of the population, what I mean? Unaccredited investor. So the idea is you can't go out and raise money from 1,000 families, at 10, 20,000, 30,000 bucks each and say, yeah, I'm going to use this to put my deal together. Because if you're doing that, you're putting a lot of families at risk. Too many families, according to law. So that's essentially what it is. Basically, the type of syndication that you do is based on whether your investors are accredited or unaccredited and how many you have. And so part of what we do is help you figure out which one is appropriate, based on who you're raising money from, their level of sophistication and financial backing and how much money you're raising, right? All those things go into deciding which type of syndication is appropriate for your deal.
Gotcha. So one other thing that I'm noticing too is there's a lot of opportunities out here now for crowdfunding.
Mm-hmm. Absolutely.
So how does that fit into this grand scheme of things?
So it's just another type of fund. It's just another type of fund. So, we've talked around the idea of a 506B fund, a 506C fund, and a 504. Those are the three that would kind of come to mind usually, or a Regulation A fund under the structure that we just talked about. But a Regulation CF fund it's a literal IRS designation. It's not like a concept. It is a law. It's called a Reg CF fund. Obviously, the CF stands for crowd fund. And essentially, there are rules around that also protect people. So in a crowd fund, you can raise money from as many people as you want, right? But you can only raise $1 million a year. Technically, it's $1.07 million.
Okay.
Okay. So a crowd fund limits exposure of people by limiting how much you can raise. So if you need to go out to the market to raise $1 million and you got to raise it from, 600 people, well, at the end of the day, you're not hitting any one of them all that hard. You're hitting them, but not that hard. You know what I mean?
Right.
So again, the law says that's okay. If it's a small enough deal, you can raise from whoever you want, right, under this structure. But here's the difference. Here's the kind of really important difference. If you notice, people aren't starting crowd funds. People are investing in crowd funds, right? You don't hear about people being like, hey, I started my own crowd fund. You hear about people say, hey, I'm on this crowd fund platform that already exists, right? And the reason is because the administration of a crowd fund is probably the most difficult one to do.
Oh, wow.
Because you got so many investors involved. You know what I'm saying? If you got 500 people investing in your deal, all 500 of them have to do all the same paperwork. You know what I mean? They have to go through all the same. Now they put a lot of it online, but at the end of the day, they have to sign all the same documents. They have to understand all the same risk disclosures. You have to answer all of their questions. You have to, provide them with their returns and their distributions and their monthly and quarterly reports for that many people. Nobody, no individual or even small company can do that. So the way that crowd funds tend to work is you get big companies that will invest millions of dollars in setting up a bunch of small crowd funds, right? And then they will go out and find people who have good deals and say, come pitch your deal on my crowdfund site, right? And then that's how people get involved in crowdfunding. It's really like a big company behind most crowdfunds.
Gotcha.
So most real estate deals aren't done that way.
Okay. All right. Good deal. So you have, before we go on, so back to entity structuring and operating agreements and all that. So what have you found? What's some of the biggest mistakes that you see new investors make, or even seasoned investors make when it comes to having the right entity structure and the right operating agreements in place?
Okay, so I'll say this. The biggest mistake is the one we talked about at the very beginning, which is people not using entities at all, right?
Okay.
You know what I'm saying? That's the number one thing.
Okay.
You want to set up a corporation for each one of your properties. That doesn't really make sense. But if you want to do that, you'll get the same liability protection at least, right? The biggest issue is just set something up. Put something in place. From there, it's really more about working together with other people. Is usually when real estate professionals will make a mistake. So what I like to say, and I think this is 100%, I don't think it's true, this is 1,000% true, is real estate is a business like any other business. So when I refer to myself as, a corporate attorney or a business attorney, that's not exclusive of real estate. Real estate is business.
Right.
It's everybody's first business, usually. You know what I mean? Like it's such a big business that people have given it its own title, but it's really just business. It's the same thing. So the issues that you see in any business deal are the same as the issues you see in any real estate deal. And what it really comes down to is when it's not just you, when you have partners in your deal, right? Whether those partners are bringing money to the table or they're, you know, putting in sweat equity and helping you get the deal done, whatever it looks like. That's where I see the most mistakes in business deals, including real estate deals. Because what folks will do is they'll, you know, do LegalZoom, Rocket Lawyer, no problem with those, right? Those work great to set up entities. Like, you know, like, anybody tells you they don't, I mean, that's not true. They work fine. As long as you can keep up with the paperwork and handle the administrative load. You know, and you don't, if you just don't want to pay anybody else a few $100 to do that for you, do it yourself, whatever, or to do it well. But anyway, but my point is, the problem is not that. The problem is when you do those types of services, they give you a boilerplate company agreement that just spits out, you know, a few general facts based on what you tell them. And usually the only thing that's in it is like the names of the people that are in the company, which tells you absolutely nothing about how the company is actually going to run. So for me, when I'm working with real estate folks, generally around their corporate structuring, it has to do with, okay, who's in your group, right? And how are you guys wanting to work together? Because a good company agreement should be looking at shares, right? And how you decided to split those shares, distributions of profits and losses, and how you decided to split those, because those can change, you know, based on different positions in the deal. Governance is probably, you know, definitely top 2 issues. How you're going to govern that deal, who's going to be in charge. I can give you an example. I had a client, maybe 6 months ago or so, who had been working with this other person for quite a while in the residential rehab space. And they said, you know, we never made this official. We need to get like a company in place. I said, okay, well, let's put your, you know, company together, but really let's focus on the company agreement, right? Like, how are you guys going to work together? Well, it turns out that, you know, when we got together and we started to go through the process that I've set out to kind of help people understand what it is to work together in a company, and like everything they need to consider, like we were just talking about, the shares and the profits and losses and the governance. Turns out both of these gentlemen thought that the other one was going to sell the other one the business in 3 years.
Wow.
And we only got that from that conversation. Like, one was like, yes, you know, I'm gonna call them Will and Bill, right? It's like, yeah, so yeah, Will and I, you know, kind of plan this out, and it's pretty straightforward. You know, I'm gonna handle this part of it, and then in 3 years, I'm gonna sell my part to him, and then, you know, he's gonna move forward. And then I've got another idea, and then Bill was like, wait, Will, no. It's like, Will, it's actually the other way around. Okay, so then that's when the conversation stopped. I was like, okay, guys, here's what we're gonna do. What the heck y'all are doing, right? You know, they had no idea. So that's probably the biggest thing. And like I said, that's in a real estate context or any other business context, is you want to have a good, in my mind, you want to have a good attorney at the table when you're figuring out the relationship between the parties. You know, even if from all the way from a company agreement, which is what we're discussing now, all the way up to like a joint venture type structure or a syndication type structure. All of it is, who are the parties? What are they supposed to be doing? Who's getting paid what? What happens if somebody wants to leave the company? What circumstances can they do that under? What happens if they don't pay the money they're supposed to pay into the company? Well, you know what I mean? Like, a company agreement in its various forms basically it tells you how the relationship is going to work. It gives you the opportunity to put on paper what your whole business relationship is going to look like. Imagine if we could do that in our personal lives. Wouldn't that be amazing? Man, we can do it in business. You know, we can literally say like, no, this is how we're going to run this. You know, you're going to do dishes on Thursdays and Sundays. Now I'm going to mow the lawn every 2 weeks on Wednesday, and we can refer back to this document that tells us how that's going to go. That's what people tend to overlook when they're starting a company. They're really excited about what they're doing together. They're really excited about how much money they're going to make. And then what happens when it actually starts to happen? That's when the problems tend to pop up. Another great example, people get a company started, you know, a real estate company, and they have big dreams, you know, to put together some deals and flip some properties and do what they need to do. Well, they actually do it. They pull it off, right? So it's a couple years in, holy moly, we've got $650,000 in this company right now. Well, what do you do with it at that point? So you got 2 or 3 partners in your company. Who gets to decide where that money goes? One of them's got a gambling thing going on, right? Dude, let me not even make it like that. Somebody's mom gets sick.
Yeah.
And they need that $300,000.
Yeah.
Can they take it from the company? What about the other 2 members? What about the next real estate deal y'all were planning on doing together? Is that allowed? You see what I'm saying? So these are the things that get missed. Is like what happens once you really are a functioning business, and all of that is a function of your corporate structuring and what's in your operating agreements. And that's where a really great a corporate attorney and real estate attorney can be pretty critical.
Wow, that is awesome, man. Because I can tell you, I've done deals with family and friends that I probably will never do again. Or if I do, you will definitely be drawing up an operating agreement.
We'll get it all on paper.
Because it's something about, man, I'm telling you, something about a great idea when it starts, but then when profits, or when you see large sums of cash coming through the account, it seems like everything changes. And I could just say, man, I've definitely learned a lesson about doing business with your network, and the importance of having agreements in place, because that way it's not going to ensure anything, but at least you have a foundation in place and something that you can refer back to say, hey, we remember when we said this, and here it is in this form. And so because some of us, man, we get financial amnesia, I'll call it.
That's a very good way of putting it.
Yep.
I totally agree, and you're right, and I think the only thing I would say is, I think it does make a massive difference, because when you think about when these disputes happen, if you've got a document in your hand that basically says, okay, we can continue this dispute, but per page 10 here, you're gonna lose, like, or I'm gonna win, or whatever, you're gonna win, then it tends to stop that stuff in its tracks. You know what I mean? It really does tend to keep people in line, because, they don't really have recourse. There's no recourse to just like yell about it or act crazy about it, or, try to raise a stink about it, because there's going to be another provision in that agreement that says, well, listen, if you want to raise a stink about this, and you don't like the way this is going, here's how you can sell your interest back to me. You know what I mean? All that stuff will be laid out already. So it just tends to make the administration of the business and the business relationships run so much more smoothly and more efficiently. And so when those conflicts inevitably arise, because we're all different people, right? You got different perspectives. When you can go back to that document, you can save yourself years, time, debating and disputing and going to court and all that stuff. So, I mean, the value is astronomical, but it's not, you don't see it when you start, right? You only see it when you get going.
Yep. That's good. So I'm going to take a pause right here, and then remind everyone again that this great episode with Sean Tate with TLC Tate Legal Consultants is brought to you by Victory Capital. Again, Victory Capital exists for one reason and one reason only, and that is to connect investors to the capital that they need. So again, go and check us out on Facebook, check us out on LinkedIn, and go to our website, VIKTORY, victorycapital.com. All right. So Sean, we had started talking about funds and deal structuring and all that. So let's talk about fund formation and private equity. If you could speak to those two things, because I'm actually the Association of Private Lenders has a course that I enrolled in. It will certify you to be a fund manager. So kind of speak to what a fund is, and how would it benefit a real estate investor or investors.
Yeah, so that's gonna kind of tie back in a lot with what we were discussing earlier, 506B and 506C funds. I'm just gonna delve into that a little further, because that's really, I mean, there's variations on it, but those are the two most common. And just based on time, I feel like we'll focus on the ones that people are most likely to see either as investors or as fund managers. So essentially, in either one of those cases, there's a core corporate structure that's in place. What that structure looks like is there's going to be a company that borrows the money, that holds the property, This company can be various types of entities depending on exactly what the deal is. Tends to be either a limited partnership or a limited liability company, but I've also seen it as a corporation. It just depends. But basically, this is the entity that's going to be the fund itself. There's an entity. It's a corporate entity. The fund is a corporate entity, and that fund entity is going to have members. On one, there's going to be usually there's no less than 2 classes of members. There can be many, many more, but there's 2 basic classes of members. We'll call them Class A and Class B, right?
Okay.
So Class A is going to be, we'll call it the fund manager, right? The manager is going to be one class, and that's the manager and everybody that's involved with the manager, right? So if you start a fund and it's you and your 6 friends and everybody's got their sort of area that they work on, then you guys are going to have a company that we're going to form that's going to be the manager.
Okay.
And that manager is going to be one class of members in the fund, right? So we got the fund, and on one side we got Class A, and that's the management team. Class B, the other members are all your investors, right? So those investors can come in as individuals, they can be different entities, they can be whatever, right? It doesn't really matter. But essentially what we have is one big entity that is the fund itself. And then under it, it will be owned by the Class A, the manager, and the Class B, the investors. That's essentially the structure, right?
Gotcha.
Way more complicated than that, but that's the basic, you know what I mean? Like pretty much a little triangle, you know what I mean? The top is the fund entity, and then on one side you got your manager folks, and on the other side you got your investor folks.
Okay.
And so then, you remember what we talked about before, the whole deal with setting up these funds is about risk disclosure, right? And making sure that your Class B folks over here, your investors, know exactly what they're getting into. So how do you do that? Well, once you've figured out the corporate structure and gotten it exactly how it's supposed to be, then you have to figure out what kind of paperwork you need to provide to the Class B folks, to your investors, for them to be able to fully understand the deal and be able to sign on in a way that protects you, the fund manager, from them coming back and saying, well, I didn't know what I was doing. I didn't know what I was getting involved in, when I started this deal. So the way you do that is through 3 documents, right? One is going to be your private placement memorandum. This document is essentially part business plan, part risk disclosure. A good syndication attorney, which I am one of, will help you figure out exactly what those risks are that you need to disclose, the order you need to disclose them in, and and how they differ from risks in other deals that people have seen. So that's a big part of the work that we do, is help you figure out the risks, because you have to disclose them all. And then again, it's also got some of your business plan in it. So your investors are going to look at that document. They're going to read it closely, hopefully. And you'll be able to say, hey, I told you everything about this deal. I told you exactly how we're doing it, why we're doing it, where your returns are going to come from, what happens if it doesn't work. And you still want to sign on, right? Essentially what this document says. Okay, so they say yes, they do want to sign on. Okay, great. Okay, so now we got 2 more documents you got to work with. You need to now fill out a questionnaire. The questionnaire is going to tell us whether you're accredited or unaccredited. Right? So you remember that part is basically, how much money do you have? How many, because I can only have up to 35 of you that aren't already at a certain level. You know what I mean? So I need you to self-certify as to your financial standing, right? I don't need to be all in your books, but you have to self-certify, like, this is where I stand, right? And then a good issuer, a good fund manager, is then going to go back and have a third-party service to verify that. And so we help to manage and coordinate that process as well. But so now you figured out who's investing, right? And then whether or not they're appropriate for your investment. So now the last part is, okay, let's sign on the dotted line. And that's called a subscription agreement. Subscription agreement is where they say, okay, yep, I read the PPM, the private placement memorandum. I read through all that corporate stuff, or I had my lawyer look at it. I have certified that I'm either accredited or unaccredited, and this is how much I want to buy. Sign on the dotted line, right? And then that's basically gets you through the first leg of the corporate documentation related to starting a fund. From there, for you as the fund manager, right? I don't know if any other folks out there are considering it, but the next part is Now you have to deal with disclosures of the actual existence of the fund at the state level and the federal level. So you have to file notices with the Securities and Exchange Commission about it, and you have to file notices in the states of every state from which one of your investors came. So if you have investors from Louisiana and Texas and Florida, then you have to file certain notices in each of those states, and the states are going to charge you for it, right? Because the state says, well, you can't raise money in my state and I don't get my cut. Right? And so we work through that process as well, you know, to make sure that you're in compliance and the states aren't going to come take your money away or take your deal away and say, you know, you owe us, you know, some insane penalty for not, you know, paying your way in to be able to invest from people in my state. So that kind of takes you through the majority of what you need to do from a legal perspective. First, it's corporate structuring. Then it's building out the private placement memorandum, the questionnaire, and the subscription agreement. And then finally, there's a compliance aspect to it at the state and federal level that you have to have in place in order to have your fund to be in compliance. Any misstep at any of these levels can ruin the deal. I don't know if you or your listeners have ever seen that show Billions. It's basically what it's about. You know, that one, Paul Giamatti plays the, you know, I don't know, district attorney of the Southern District of New York, I think, in that deal. But every state and every, you know, jurisdiction has somebody whose job it is to look at deals like this, you know, on behalf of disgruntled investors and make sure all this stuff is right. And if any of it is not right, they will take your stuff. You know what I'm saying? They will divest you of your investment. They will penalize you. People go to jail for it every day. You know, it doesn't really make the news. It's not as interesting, I guess, as some of the stuff we like to see on the news. But yeah, you know, I follow that news, you know, securities news. And yeah, people go to jail and lose everything all the time for not doing this the right way. So
it seems as if I'm understanding you right, the higher you go from, say, you're starting out fixing, flipping, say you're buying and holding, if you want to move to, say, buying multifamily or buying office buildings, whatever that next step is, the higher you go, the more you need someone such as yourself on their team.
Agreed. 100% agreed. And once you get to that level where really I think it's just good business to have an attorney there whenever you're working with other people, right? Because again, there's all those aspects of a deal that you just don't see when you're getting into it. You think you see everything, you don't. You know, that's what a good attorney's for, to see the, you know, legal implications. Great CPA is there to see the tax implications. You know what I mean? Like none of us knows everything. I don't know everything. You know what I mean? I know a lot of stuff. So I think it's really important for every deal, you know, that you're going to do with other folks to have the attorney there. But once you start raising money from people, and it doesn't matter how big the deal is, you know what I'm saying? Right now, I'm doing a private placement where they're only raising, I think, about $330,000. But it's the same. They're subject to the same rules.
Wow. Okay.
They're subject to the same rules. We did a deal in December where the raise was $47.5 million. Same rules.
Okay. So let me ask you this, in speaking about capital raising, if you can, and this is a piece that, even though, you know, I've been in the financial world, I've worked in several sectors and all that, I never quite understood the private equity piece. I understand the getting debt. I understand that part of it, but are you involved in helping people raise capital, and are you part of that capital raises? Are you involved in any kind of private equity raises?
Well, guess what, Aline? I got news for you. You do know what it is because we just talked about it. That's what it is.
Right.
That's private equity. What we talked about is just breaking down the two words. So private means basically that it's not a public company, right? We have it register and put it on the stock market. Anything that's not out there on the major stock markets where you can buy and sell it there is considered private.
Gotcha.
And we're talking about raising money from people. We're not talking about going to the bank. That's equity.
Okay.
Like literally, this is private equity. Now there are other aspects of it other than just like raising money in this way. So another form of private equity is, for example, preferred equity. And so what does that mean? It means like, say you have a company and I want to invest in that company, and I come in as an investor. That's a private equity deal, right? And so I would want preferred equity, which would mean like, I'm going to, put $1 million into your company. I want to make sure I get my $1 million out before anybody else gets paid, right? That's basically a preferred equity structure. All that falls under the realm of private equity. Okay. Crowd funds are private equity. Okay. You know what I mean? It all kind of falls under the same umbrella of anytime you're raising money from somebody, that is private equity, unless you're doing it on a public level, where you're going through the SEC's sort of list of things you have to do to be able to put your product on a tradable public stock market, which that's not what we're talking about at all. Outside of that, it's all private equity.
Gotcha. One last thing on this, and man, I knew this. This is going to probably be a 2-part series. I'm going to probably have to take this and split this up. But speaking of private equity, so now there is, which is the space that I deal in, hard money lenders and private lenders. So what is there anything that a real estate investor needs to do in that area as far as protecting themselves? Or if somebody wanted to go out and solicit funds from private individuals, protecting themselves in that way as well, trying to make sure that the individual or the private person that they go to and say, hey, here's an opportunity. I need 500 grand. And then you start to outline, what you're going to offer them and all that. How do you protect yourself in those areas?
Yeah, see, that's the funny thing, man. I'm just being honest with you. Those deals happen all the time, kind of off the books, where people will just kind of come together with somebody and make a deal. The line that needs to be drawn is about how close that person is to you. Okay. Again, going back to the law just cares about like, if you went out and solicited to find that person, right? Then you have to put in place everything we're talking about from a legal perspective. You know what I'm saying? If you know that person through some other means, right? And the closer you are to that person, the more familiar you are with that person, the less important it is for you to have all that extra paperwork.
Gotcha.
Basically what it comes down to. So in a situation like what you described, if it's just 2 individuals and that person's got $500,000 to put on the table, in all likelihood, that person's done a lot of deals, at that point, right? And they know what they're doing, and they know you, and they vetted you, because they're not just going to throw $500,000 at you, out of nowhere, right? In all likelihood, that's the case. So in that case, you're looking at something more like a joint venture, right? A joint partnership, or a simple limited partnership between a few folks who are, sophisticated business owners. You can definitely do that in that scenario. The problem comes if it's somebody who got an inheritance of, $750,000, and you go to them and say, hey, I know you got this inheritance. You know what I mean? I sure would love to do this deal with you. If it works, they'll love you, right? If it doesn't work, if something goes wrong, if they get unhappy, they're going to call an attorney.
Exactly.
That attorney's going to say, well, what did they tell you about this deal? You know what I'm saying? How did they, explain the deal? Where did they show you all the risks of the deal? And if you don't have that private placement, if you don't have that subscription agreement, if you don't have, even if it's one person, you know what I'm saying? If you don't have that stuff, guess what? SEC's coming for you. It's just that simple. You know what I mean? And people get away with it, sometimes, but for the most part, like, what you don't hear about is people. Nobody wants to talk about that time they went to jail.
No.
Taking $500,000 from somebody.
No, they don't. I'm sorry. All right. So one other area, Sean, that you specialize in is leasing. So how do you help business owners with leases? And I think you said medical and Well, what areas do you help?
Yeah.
I'm sorry.
So for me, man, it's going to be medical and dental is kind of my specialty
Okay.
uh, in the leasing world. All retail leasing is pretty similar, and I've done probably about 500 leases, I would
Oh,
say, at this
oh,
point.
okay.
And that largely has to do with the fact that when you go into a law firm and you work in their real estate practice, that's what you do, right? Basically, they sit down with stacks of leases up to the ceiling, and they're like, "Good luck," you know. So I kind of got that experience there. And once you know it really well, it's with you. Basically, for anybody that's going into a lease, I mean, obviously folks know this, it's not that different than what we're talking about, company agreements. At the end of the day, you want to make sure that if you're going to be in a long-term business relationship with somebody, like a landlord to a tenant, whether you're on the tenant side or the landlord side, right? You want some rules in place, right? This could be a 10-year, 20-year relationship. And so a lease is going to contemplate all those same things, just like a company agreement does. What happens if kind of stuff, you know what I mean? Fill in the blank.
Gotcha.
And so, for any lease, you're going to be looking at things like what happens if the HVAC breaks? What happens if I need reserved parking up front? And, because of the nature of my business, I need people to be able to get, in and out really quickly. What happens if, the property taxes on that property go up to a certain level? Who's responsible after a certain? What happens if the place burns down? Do I get out my lease automatically? By the way, no, you don't. For most people, most leases that you might sign, no, you don't. So you want somebody to help negotiate those kinds of things for you, right? So just in general, a lease is another kind of like what happens if kind of document, right? That is people sign them all the time and then they read them later. They only read them funky, and then they're like, oh my gosh, I signed that. So my job used to be working for the landlords, big, massive landlords, to craft those agreements in favor of landlords. Not my favorite part of my legal practice, not the part I'm like most proud of. But I can tell you what, I know what goes into them, and I know how they can sort of like, really hamstring tenants in ways that they can't get out of their leases, even if it's the landlord's fault, right? For any number of issues. So that's just in general, right? It's just good to have, I think, a good leasing attorney to kind of take a look at the document, walk you through it, and let you know what's in it, so you understand what you're signing. Some people will still sign, and I think that's fine, but it's just, you should at least know what you're signing. The worst thing is, I did not know that I was even in this deal the way that I'm actually in it. So
Gotcha.
that's just in general for retail. But then within retail, right, which I would include medical and dental in retail, because they're kind of retail shopping centers and strip centers and things like that. It's a specialty within that. And so, so when you're looking at a medical or dental lease, there's different things you're looking at there that you're not looking at in other situations. One that I find that comes up a lot, it's extremely important, is exclusivity. So I think a lot of retailers like exclusivity, but I think it's really important for medical professionals. So, for example, if you're a burger joint, right? It doesn't really matter if there's an Italian food joint, like in the same strip center.
Right.
Might be good, you might want them there, so that some people, maybe if they're in the mood for a burger, they go to your place. If they're in the mood for pizza, they go to their place, right? But if you're a dentist, right, or an orthodontist, you definitely don't want another orthodontist or dentist in the same, you know what I mean? You need your zone to operate in, right? So one of the things we look for and negotiate for is making sure that, the exclusivity rights are really strong, for tenants. If I'm representing a tenant, if I'm representing a landlord, we might be looking at it a little different, but the point is, like, the issue is the same, right? Another major issue is going to be their equipment. So landlords like to put liens on your equipment, right? So they like to say, hey, look, if you're going to, rent from me, and you don't pay your rent, I'm keeping all your stuff. Is basically what it comes down to. You can't do that with a medical professional. Why? Because there's like $1 million worth of equipment in there that they don't own. You know what I'm saying? It's usually owned by a third-party medical equipment company, or, it could be optometrist, it could be dental, it could be medical, same concept. So we have to negotiate for what that landlord's lien looks like when there's a third party involved that has rights in that particular property, right? So that's another big one that comes up. Another one that I see a lot of attorneys miss, that I think is critically important, is addressing HIPAA laws, right? So, HIPAA is basically your medical privacy laws.
Mm-hmm. Mm-hmm.
So if you get in a dispute with your landlord, or heck, if you go out of town, or if your landlord needs to get into your place to fix the busted pipe, you can't go through the files. You can't keep the files. You cannot access the files for any reason, right? Because what could happen there is you could be a doctor whose, files get left with a landlord that you're in a dispute with, and now you're getting sued by all your patients because now their data has been exposed to third parties that have nothing to do with what, with what your relationship was, right? Wow. So you have to negotiate your HIPAA provisions in there as well. There's about 6 or 7 more. I'm not going to go into all of them. But my point is there's a very particular way to negotiate a lease for a healthcare professional that's different even than other leases.
Wow.
So yeah, we do a lot of that work as well. And we look forward to, working with your audience if they have any needs in that area.
Man, that is awesome, because I can tell you I have leased space before, and all of this is like new to me. I mean, I just signed. I mean, I was just so happy that somebody was going to lease me a space. So it's like, man, you have just really magnified for me the reason to have someone such as yourself on my team. So, so Sean, what we're going to do is start wrapping this up, because, man, I could just spend hours with you just talking about all this, because I told you I don't want to make the same mistakes again. So, but Sean, so what's next, man? What's next for Sean Tate?
Well, right now, man, we're just growing. I'm very, very thankful, very blessed to just be in an aggressive growth mode as a firm. Mm-hmm. We're sort of bifurcating into 2 areas, focusing on small business needs and micro business needs. Okay. Because, for me, again, I come from a social work background, man. So it's extremely important to me that, at least some of the services that my firm and the attorneys I work with offer are available to folks that, maybe, big law prices don't work for them. You know what I mean? Or maybe they just need access to resources and education. So we're building out an educational resource platform for small businesses to be able to just learn, the things they need to kind of know to kind of get into business. And then, of course, to offer legal services as needed, and at price points that tend to work well, and then on the other side, again, we've been just kind of going gangbusters, in terms of larger corporate deals, structuring funds. In the 6 months before COVID, we closed about $475 million in private equity, which again is going to be the fundraising stuff. Syndications are part of private equity, right? So it wasn't the only thing, but we've just had a lot of activity in that area. There are deals moving every day. So for us, what's next is just holding on for the ride, and continuing to grow and adding new staff members and adding new team members to be able to service the clients.
Great. All right, so Sean, at this segment, man, I always ask like 2 or 3 quick questions. They don't require a lot of thought, just so that people could get to know you. So yeah. So you have a client coming in town, you have family coming in town, they're coming to see you, Sean. So where are you going to take them to eat? Now, okay. This is pre-COVID, I guess.
Yeah, it is, right. We're at the house. Okay, we're grilling. I've gotten something, man. My grill's, I'm starting to feel like one of my uncles. How they can just grill and just tear it up all day. I'm getting there, so that's been fun. But pre-COVID, that decision was really for me not so much about the food, but about kids, and I'll explain what I mean by that. So I have 2 young boys. Okay. They don't sit still very long. Okay. Right. So we're not going to no fancy restaurant. At the same time, we need to go somewhere where there's ample seating and that they serve the food pretty quickly. And we're not going to be waiting for 45 minutes for a good meal, right? So Veracruz Cafe was kind of our go-to, man. Again, I mean, the food's good. Don't get me wrong, food is good. But it was really about, we could walk in there, get food within about 15, 20 minutes, eat well, and get out. Okay. So whereas we probably go to Veracruz Cafe. And if I want to take take folks to places that, I really enjoy, where that's not, part of the scenario.
Mm-hmm.
There's a couple of places. I like Double Eagle, which is a steakhouse, Del Frisco's
Mm-hmm.
off of McKinney.
Mm-hmm.
And then I live in South Oak Cliff, so South Dallas Cafe is kind of my go-to when we're gonna get some soul food going. But again,
What?
is either one of those places.
That's good. That's good. So 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 Sean, so what books are you currently reading?
Good question, man. Let me see here. Am I reading anything? Huh. Well, I finished The Warmth of Other Suns not too long ago,
Okay.
which is a book about Reconstruction era in the
Okay.
U.S. That one just made me mad, I'll be honest. A lot of beautiful stories about Black people in migration north, post-slavery and during Jim Crow.
Yeah.
Read another book recently called The Color of Law,
Mm-hmm.
another book that made me mad. But it is a great book, man. It's probably one of the best books I've read on how the laws were set up to exclude Black people in particular
Mm-hmm.
from real estate.
Mm-hmm.
And I'll just quick side note, just to let you know. I remember when I first became an attorney. I remember the first time, because it was only about 2 months into my time as an attorney. We review title on deals all the time. We're looking at who's owned title in the past, and so we get every document that's ever been filed on a particular property.
Mm-hmm.
And I would say about once every 2 months or so, I would get a property or get a deed in that said specifically, you can never sell this property to Negroes.
Yep. Yep.
You know what I'm saying? And
Yeah.
I remember the first time I'm sitting in my office, fancy, I'm a little suit on, and I'm like, like these are deeds from the 1950s. We're not talking like the 1800s here, right? We're talking about the stuff that our parents, were going through. And so I think it was really instructive to me about how wealth is distributed in this country, and the fact that people could literally legally lock us out of that. And they did, not they could, they did lock us out of land ownership. And so, of course, we would always throw those documents out and say this document is no longer relevant because we don't discriminate based on, all this stuff. But the fact is, my grandfather did not have, an attorney that looked at that and said, well, that's not legal. He just couldn't buy the land. Right. So the book Color of Law, I think, does a really good job of encapsulating the various ways in which, in particular, the real estate industry has been used to funnel wealth towards certain folks and away from others. And then I'm reading this really cool book by this Turkish author. It's like a Holocaust book, it's like beautifully written. There's a lot of poetry in it. So I'll read that one before bed sometimes.
Well, cool. That's good. I'm gonna have to get the Color of Law. I like that. Yeah. All right. So then last question, man, and this is always a reflective question. So what would Sean Tate now tell Sean Tate 20 years ago?
Be patient. He would tell me, I would tell him, be patient, man. Like, just take it easy. I've always been kind of a hard charging person. I always wanted everything right now. And I think that sometimes when you move too fast, you miss what's in front of you. And you miss the opportunity to appreciate and be grateful for and truly, take in what you already have, looking for the next thing all the time. So I would have told myself to be patient and enjoy today. And that's definitely something that I work really hard on now. I have my own family and, just taking a break from the chaos to, remember how blessed I am and we are. And I wish younger Sean could have done a little bit more of that.
Good deal. Well, Sean, man, I just want to tell you, man, thank you so much. I'm definitely going to have you on again because there's just so much out here. And as real estate investors, as you and business owners, as you progress and your assets start to increase, the more protection that you need. And I just want to emphasize, get the protection in place before you need it. And so you're protected. And so and so that you don't learn these hard lessons that I learned through trial and error and through loss, and having to rebuild because I didn't have certain operating agreements. I didn't have certain structures. I didn't have team members in place. And so, man, I just want to thank you for taking out the time to speak with our audience today. And man, I wish you much success. Okay. Oh, and I'm sorry. How can our audience get in contact with you? I almost forgot that. How can they get in contact with you, man?
No, that's great. Thank you again for having me. I really enjoyed speaking with you today and sharing. And yeah, you can always reach out to us to discuss deals. If you got deals on the table, or you're again thinking about, as you said, partnering with other folks and kind of taking your business beyond that level of just trying to do a sole proprietorship deal, all the way up to if you're trying to raise money, put together a deal, like we can be there for you for that. Our main contact number is going to be 972-946-6262. And you can also reach us via email at info@tate-legal.com. That's info@tate-legal.com. And of course, feel free to check out the website, peruse it. That's going to be tate-legal.com. So look forward to hearing from folks, and Godspeed and best of luck in your real estate ventures.
Good deal. And I'll make sure that I put all this in the show notes. So they will be there. Again, Sean, thank you so much for your time. All right.
My pleasure. Thank you, Elaine. Have a great day.
All right.